The dollar just took a hit. It can't casually walk off. And the next move in gold and stocks won't be decided by headlines. It'll be decided by forced positioning. Because the story everyone is repeating right now is tidy and comforting. The Fed does its thing, the market digests it, and then we go back to business as usual. But the tape is telling you something messier. Gold is acting like an insurance premium that suddenly got repriced higher. Stocks are acting like nothing can touch them. And the dollar is acting like it just lost a layer of authority. Those three don't stay in perfect harmony for long. And the part most people are missing is the one mechanism that quietly dictates how large the next move can get. In a tight window around the decision, you saw the kind of everything at once behavior that makes professionals stop talking and start checking their risk screens. The Fed holds steady, stocks flirt with a big psychological milestone, gold makes fresh highs, and the dollar slides into territory that traders remember for all the wrong reasons. It looks like one big risk-on party. It looks like a clean inflation hedge bid. It looks like the market is simply pricing in what it already knew. But that's not the part that matters. The part that matters is what this configuration forces large players to do next, when their models update and their hedges become expensive at the same time. Here's the underappreciated detail that reframes the entire setup. Gold isn't to just going up. The carry math around gold is shifting, and that changes how big money is allowed to size risk. Most people look at gold like a belief trade, like a fear barometer, like a mood ring for the world. But institutions don't run on vibes. They run on financing, hedging, and constraints. The difference between gold is rising and gold is rising while carry becomes more favorable or more punitive is the difference between a move that stalls and a move that feeds itself. And if you want to understand what's next for both gold and stocks, you have to watch what's happening under the hood in the plumbing, not just what's happening on the chart. Because the chart is where retail gets hypnotized. The chart is where the narrative is sold. The real pressure shows up in how the market prices time, in how it prices delivery, in how it prices the cost to be short, and how it prices the insurance against a gap. And once that starts shifting, everything else, dollar, gold, equities, becomes a set of dominoes, not independent stories. And the timing is not random. This is hitting right into the kind of calendar window where markets move harder than they should. You're dealing with post-FOMC repricing, month-end positioning, and the kind of liquidity thinning that makes small flows feel like big events. Funds rebalance, volatility targets rebalance, risk parity knobs get turned, hedgers adjust. And when those adjustments happen after a catalyst, you get a second wave that surprises everyone who thinks the event is over. That's where the real squeeze potential starts. Not necessarily because someone's evil, not because someone's manipulating, but because the incentive structure and the risk management mechanics force hands. Let's talk about the dollar shock first, because people underestimate what a sliding reserve currency does to the rest of the system. A falling dollar isn't just an FX headline. It changes collateral preferences. It changes hedging costs for international investors. It changes the translation math for multinationals. It changes how fast capital moves between safe assets and performing assets. And it can flip sentiment on a dime, because the dollar is not just a currency. It's the global accounting unit. When it wobbles, the whole room hears the floorboards creak. Now, I'm not here to tell you the dollar is finished or that the world is suddenly abandoning it overnight. That's cartoonish. What matters in the near term is this. When the dollar drops fast enough, it forces a repricing in a bunch of linked markets. Commodities reprice in dollar terms. Emerging markets breathe easier until they don't. U.S. financial conditions can loosen until the market decides the looseness is a problem. And the key, a weaker dollar can be interpreted two ways simultaneously. One interpretation is bullish. Easier conditions, better earnings translation, more global risk appetite. The other interpretation is defensive. Policy uncertainty, inflation risk, and a rising risk premium for holding long duration promises. You can see that tug of war right now. Stocks are celebrating the bullish interpretation. Gold is hedging the defensive interpretation. And the dollar is the battleground where those interpretations fight. Here's why gold's move looks emotional but isn't. Gold's price is a composite of expectations and costs. Expected real rates, currency effects, and the practical cost of carrying and hedging exposure. When people say gold rises when rates fall, they're compressing a complex machine into one sentence. The more accurate framing is, gold becomes more attractive when the opportunity cost of holding it falls relative to alternatives, and when the market decides the insurance component is worth paying up for. The insurance component is not a conspiracy. It's a rational response to uncertainty about purchasing power, policy, and tail risk, now layer in a dollar drop. When the dollar weakens, dollar-priced gold mechanically looks stronger, but that's only the first layer. The second layer is psychological. A weaker dollar makes the gold bid feel validated, and that draws in marginal buyers. The third layer is structural. When volatility rises and correlations wobble, portfolios that thought they were diversified suddenly aren't, and gold gets pulled in as a stabilizer. And then comes the hidden layer that almost nobody explains clearly: the market's pricing of time. Time and financing around gold can change the behavior of both longs and shorts in a way that either fuels or deflates the move. This is where paper versus physical becomes a legitimate finance-literate concept without going off the deep end. Gold trades as futures, forwards, swaps, options, ETFs, and physical bars. Those are all connected, but they don't always move with perfect harmony, especially in stressed windows. If you're a trader looking to short gold, you're not just saying, I think the price goes down. You're taking on a financing position. You're taking on a volatility position. You're taking on the risk that the market doesn't give you a clean exit. And when the carry math shifts against shorts, it can make the trade more expensive to maintain and more painful to roll. Think of it like this: the market doesn't just price gold, it prices the cost of owning gold over time. It prices the benefit of having it now versus later. It prices the rent on the metal, in a sense. When that rent changes, it changes who can hold what size. That's not narrative, that's risk management. Now let's pivot to equities, because the stock side of this triangle is where complacency can get punished. Stocks tagging a major milestone as being sold as proof that the system is stable, that liquidity is abundant, that the Fed isn't a threat, and that the future is bright. And maybe that's the base case, maybe. But there's another layer. When a market is near a milestone, positioning tends to be crowded and hedges tend to be thin. Investors get comfortable selling volatility. They get comfortable buying dips. They get comfortable with the idea that any bad news will be met with stimulus. And that comfort is precisely what makes the next air pocket possible if the cross-asset regime shifts even slightly. Here's the uncomfortable truth. The same dollar weakness that can flatter multinational earnings can also raise the risk premium if the market starts reading it as disorder rather than easing. People forget that currencies carry emotion and politics and credibility. A controlled, gradual dollar drift is one thing. A sudden, sharp move is another. If it feels like a loss of control, multiples stop caring about next quarter's earnings translation and start caring about volatility, inflation, pass-through, and policy response. And when that happens, the equity narrative can flip fast. So what's the mechanism that could make what's next arrive quickly, even this week? It's reflexivity driven by risk constraints. Let's make it plain. A lot of money in the market isn't sitting there making philosophical decisions about gold versus tech stocks. A lot of it is running systematic mandates: volatility targeting, risk parity, trend following, option overwriting, delta hedged strategies, macro relative value. Those strategies have rules, and those rules can force buying or selling that looks irrational to outsiders. When volatility rises, volatility targeting funds often reduce exposure. When correlations spike, risk parity reduces risk. When price trends break, trend followers can flip. When dealers are short options and price moves through key levels, delta hedging can create feedback loops. And when margin requirements rise or P&L drawdowns hit thresholds, leveraged players are forced to cut. None of this requires a villain. It requires math and constraints. And this is why the shock doesn't end when the Fed statement hits. The Fed is the spark. The next day's flows are the firewood catching. So let's start stacking proof, because we're not doing a vibes-based video. Proof point 1 is the coexistence problem itself. Gold pressing into record territory, while equities celebrate and the dollar slides. That's an unstable triangle. It can resolve in multiple ways, but it rarely stays perfectly balanced. Proof point 2 is the dollar's weakness into multi-year territory, which changes behavior across commodities and hedged global portfolios. Proof point 3 is the equity milestone behavior. A market making new highs tends to compress volatility and reduce hedging, which ironically sets up sharper moves when something breaks the calm. Proof point 4 is the policy posture. A hold can be interpreted as steady, right? But it also leaves the market hypersensitive to the next data print or the next Fed communication, because the marginal change in expectations can move rates, and rates move everything. Proof point 5 is the under-the-hood gold signal, the way the market prices time and carry and hedging around gold, which can tighten the screws on shorts and draw in institutional hedgers. Add a sixth proof point that's more street level and qualitative. When gold breaks into new territory, you often see a change in how people talk about it. Suddenly it's not dead money. Suddenly it's insurance. Suddenly it's a portfolio stabilizer again. That narrative shift matters because it affects allocation committees and the willingness of institutions to increase a sleeve, even modestly. Even a modest increase at the institutional level is huge in flow terms compared to what most people imagine. And here's the seventh layer most people ignore: global comparison. If the dollar drops, gold can behave differently across currencies. Sometimes the most important signal isn't gold in dollars, it's gold in euros, gold in yen, gold in local terms. If gold is strong across many currencies, it suggests the move isn't purely a dollar translation effect. It suggests a broader demand for the hedge itself. That matters for the durability of the move. Now, before we go further, let's address the counterpoints cleanly, because credibility comes from mapping what can break your thesis. There are straightforward ways this could unwind. The dollar can snap back. That can happen on a single headline, a single shift in expectations, or a single risk-off event that triggers a dash for dollar liquidity. If the dollar snaps back hard, gold can pull back even if the long-term thesis remains intact. Another counterpoint, gold can be overextended in the short term. When an asset makes a strong run, it becomes vulnerable to profit-taking, especially around calendar windows when funds lock in performance. Another counterpoint, equities can continue melting up because markets can stay irrational longer than anyone expects, and because concentrated leadership can keep index levels buoyant even if the average stock is tired. And one more, the Fed can communicate in a way that reasserts hawkish credibility, pushing real rates up, which can pressure gold and support the dollar. Those counterpoints are not reasons to panic, they're reasons to structure your thinking so you don't get emotionally whipsawed. Because even if the big picture is right, the path can be brutal. So let's turn this into the two-scenario lens you need for the next 1 to 2 weeks. Scenario 1 is the controlled pullback and retest. In this scenario, the market digests the move, the dollar stabilizes at a key zone, gold cools off without breaking its structure, and equities hold up but rotate internally. This is the healthy scenario. It's annoying because it feels like nothing happens, but it sets the stage for the next leg because it allows positioning to reset without a crash. In a controlled pullback, you look for gold to stop panicking on dips, for pullbacks to be bought with less drama, and for the dollar to stop accelerating lower. You look for volatility to rise modestly, not explode. You look for equities to churn rather than break. Scenario 2 is the continuation squeeze and gap risk scenario. In this scenario, the dollar continues sliding, gold doesn't give back much, and the market starts to smell forced buying. That's when you can get air pockets. That's when you can get gaps on thin liquidity. That's when a small catalyst becomes a big move. The squeeze case doesn't require a new narrative every day. It requires the market to remain off balance long enough that hedges get chased, shorts get squeezed, and systematic funds are forced to adjust. In this scenario, you'll feel it in speed. You'll see it in how quickly price moves through levels. You'll see it in how shallow the pullbacks become. And you'll see it in how headlines start chasing price rather than leading it. Now let's talk levels without pretending we can pinpoint exact ticks like a fortune teller. For the dollar, the key is whether it holds a stabilization zone or breaks into a new leg lower. Think in terms of behavior. Does the dollar sell off and then bounce with conviction, or does every bounce get sold immediately? If every bounce is sold, the pressure is still on and gold's tailwind remains. For gold, the key is whether new highs get defended or rejected. A healthy move can pull back and retest prior breakout zones and then hold. An unhealthy move spikes and then collapses back into the range quickly. For equities, the key is breadth and volatility. Are the same few names dragging the index higher while the rest of the market weakens? Or is participation broad? Is volatility staying suppressed? Or is it starting to leak upward even as price holds? Because here's the thing, the most dangerous equity setups often happen when the index looks fine, but the internals deteriorate. That's when a small shock can produce a bigger break, because the market's support is narrower than it appears. That's where the real pressure starts. Now, let's go back to that hidden detail again and make it practical. When you hear carry and curve, it can sound abstract, but here's the translation into what it forces participants to do. If the structure of the futures and forward pricing makes it less attractive to stay short, shorts have to cover sooner or smaller. If it makes it more attractive for institutions to hold exposure, the bid becomes stickier. If it signals tighter availability or higher value for immediacy, the market can treat gold less like a speculative trade and more like inventory with a premium. And when an asset transitions from being treated as a trade to being treated as a form of inventory or insurance, it tends to behave differently. Pullbacks get bought faster, dips become shallower, options pricing changes, and that in turn changes dealer hedging behavior, which can feed back into the spot move. Now let's add the options and hedging layer, because this is where things get very real very fast. In equities, a lot of the short-term price action is shaped by options positioning and dealer hedging. When markets are calm, selling options can feel like free money, and dealers manage their exposure smoothly. But when price moves through key strikes, hedging flows can accelerate. That can amplify moves both up and down. If the market rallies through heavy call strikes, dealers hedging can chase it. If the market drops through heavy put strikes, hedging can push it lower. The exact direction depends on positioning, but the mechanism is consistent. The options market can turn price into a reflexive loop. In gold, options matter too, but the more universal short-term accelerant is simple: leverage and margin. When a trade moves against you and volatility rises, margin requirements can increase, and that forces liquidation. If you're short and the market rips, you have to post more collateral or cut. If enough players are forced to cut at the same time, you get a squeeze. And squeezes are not about belief. They're about constraint. That's why they're violent. Now, here's the crucial so what for this week. When you're in a post-event month-end window with a cross-asset shock, the next move is often dictated by who is forced to act first. Is it the equity vol seller who has to cover because volatility finally rises? Is it the macro fund short gold as a hedge that now has to pay up? Is it the corporate hedger adjusting FX exposure because the dollar moved too far too fast? Is it the systematic fund de-risking because realized volatility picked up? Whoever has the most urgent constraint becomes the marginal price setter, even if their view is wrong. That's what people mean when they say flows drive price. It's not mystical, it's mechanical. And this is also why you have to protect your psychology right now, because the market will try to harvest your timing. The market's favorite trick is to weaponize your emotions with volatility. First, it gives you a clean breakout, and you feel late. Then it gives you a sharp pullback, and you feel stupid for chasing. Then it chops sideways just long enough to drain your confidence. And then it moves again, often in the original direction, after you're exhausted. That's not personal. That's how markets transfer money from impatient hands to patient hands. So here's how you shield yourself. Separate trend signal from noise. Trend signal is structure, higher highs and higher lows that hold key zones, a dollar that either stabilizes or continues its leg, a market that either sustains demand or shows repeated rejection. Noise is the intraday drama, the headline spikes, the 1 hour flush, the emotional commentary. You don't need to predict every wiggle. You need to know what would invalidate your thesis. You need to know the one or two if this happens. The math changes conditions. For gold, invalidation in the short-term sense often looks like a failed breakout. Price surges, cannot hold above the prior range, and then sells back hard, turning the breakout into a bull trap. For the dollar, invalidation of the continued weakness, thesis looks like a powerful reversal that holds and then starts making higher lows. For equities, invalidation of the complacency continues thesis looks like volatility rising, while price fails to make progress, or breadth collapsing while the index hovers. Those are warning signs. Now I want to give you a concrete what to watch next checklist that doesn't require you to be a pro, but will keep you aligned with the real drivers. Watch 1. The behavior of the dollar on bounces, not the headlines, the bounces. Are bounces being sold immediately, or do they hold? Watch 2. Gold's reaction to pullbacks. Does it snap back quickly or does it bleed? Watch 3. Equity volatility. If volatility starts rising even while the index looks okay, that's a regime shift tell. Watch 4. Equity breadth and leadership. Is the market being held up by a narrow set of names or is it broad? Watch 5. The speed of moves around key sessions. Thin liquidity windows exaggerate truth. If moves get faster and cleaner, it often means positioning is being forced. And here's the quiet metric most people ignore, but you should respect. The pricing of time around the hedge. In plain language, does the market treat gold like something you want now or something you can buy later without penalty? You don't need to stare at complex screens to understand the concept. Just understand that when the market starts rewarding immediacy in a hedge asset, it can be a sign of deeper stress, even if the surface looks calm. Now, let's address the elephant in the room. What does this mean for gold versus stocks? The honest answer is, it depends on which side of the triangle resolves first. If the dollar stabilizes and risk appetite remains strong, equities can keep grinding higher, and gold can consolidate rather than explode. If the dollar keeps sliding and volatility picks up, gold can stay bid as insurance, and equities can become more vulnerable to sharp pullbacks, even if the long-term trend remains upward. If the market interprets the dollar drop as easing, you can get a weird world where both gold and stocks rise for a while. But if the market interprets it as disorder, then gold can rise while equities wobble, and if you're waiting for a single headline to tell you which world you're in, you'll be late. The market will show you through behavior. Now let's make this practical for someone who's finance-minded, skeptical, and allergic to empty hype. You're not here to be told, buy this, sell that. You're here to understand the mechanism and the risk. So I'll say it cleanly. Price can whip around violently, even if the thesis is correct. A bullish gold thesis can still include sharp pullbacks. A bullish equity thesis can still include sudden air pockets. The goal is not to eliminate uncertainty. The goal is to map it so you don't get used by it. If we get the controlled pullback scenario, your job is patience and structure. Let the market retest. Let the dollar show whether it's stabilizing. Let gold show whether it can hold its new zone. Let equities show whether they can maintain breadth without relying on a handful of names. If that structure holds, it often sets up a higher quality move. If we get the squeeze scenario, your job is respect and humility. Don't chase strength blindly. Don't assume the first dip will be the last. Understand that thin liquidity can create gaps. In a squeeze environment, stops get hunted and entries get punished. The market will dare you to overreact. And here's the part that flips the whole setup. If the $S weakness starts feeding into inflation expectations or a credibility narrative, the Fed reaction function becomes the next domino. Markets can love easing until they fear it. They can love cuts until they see currency stress. If the market starts thinking the Fed is trapped, unable to cut without weakening the dollar further, unable to hike without breaking growth, that's when gold's insurance bid can become stubborn. And that's when equities can stop looking like a one-way escalator. Again, no certainty, just mechanism. So how do you keep a trust in your process when the tape tries to shake you out? You anchor on your checklist and your invalidation levels, not on your emotions. You remind yourself that volatility is not a sign you're wrong. It's often a sign the market is transitioning between regimes. You size in a way that doesn't force you to make decisions under panic. Because the moment you're forced to act is the moment you're most likely to act badly. That's why institutions obsess over risk constraints. That's why the market punishes over-leverage. Over-leverage turns a thesis into a coin flip. Now, if you're looking for a near-term roadmap, think in terms of days, not months, because this is a right-now window. In the next week or two, watch for one of two confirmations. Confirmation A, the dollar fails to reclaim ground, gold holds its new zone on pullbacks, and equities show internal stress even if the index holds. That's the setup for gold to remain strong and for equities to become more reactive to shocks. Confirmation B, the dollar stabilizes and starts making higher lows, gold pulls back but holds structure without panic, and equities keep breadth and suppress volatility. That's the setup for a grind higher in stocks and a consolidation in gold, rather than an immediate vertical move. And if neither confirmation appears, if everything just chops and headlines whipsaw you, that's also information. It means the market is digesting positioning. It means the next move is being prepared. It means you're not supposed to feel comfortable. That's normal. Let me leave you with the cleanest way to think about this without getting lost in noise. The dollar is the signal for global stress versus global ease. Gold is the signal for the insurance premium the market is willing to pay. Stocks are the signal for how confident capital is in the growth narrative. Right now, those signals are not in perfect agreement. When signals disagree, the next move tends to be sharper because someone is wrong and someone will be forced to adjust. And the hidden detail, the carry and time pricing mechanics around gold, can tell you whether the gold bid is fragile speculation or sticky institutional insurance. If you're the kind of person who wants a simple identity check at the end, here it is. Most people want predictions. The serious crowd wants a process. The serious crowd wants to know what matters, what confirms, what invalidates, and what to watch next week when the market tries to distract them with drama. If that's you, you're already playing a different game than the average viewer. And you don't need to be the first to move. You need to be the one who doesn't get fooled by the fake out. So keep it tight. Watch the dollar's behavior on bounces. Watch gold's ability to hold new ground. Watch equity volatility and breadth. Respect the calendar, because month-end and post-event windows can make moves look irrational before they look obvious. And remember, the market's job is not to reward your certainty. It's to test your discipline. And if you want to be on the right side of that test, don't chase the headline. Chase the mechanism. Because if this one level breaks, the math changes. And that's where the real pressure starts.